Hey traders, my name is Akil Stokes and welcome to another weekend review video. If this is your first time joining me, I'm a full-time professional trader. I'm also a trading coach over at TradeEmpowered.com, where I participate in a handful of programs, starting with our syndicate program where I share my daily trading ideas, to my live trading room where I trade the markets live 3 hours a day with a wonderful community of traders. And of course, I run a training course where I teach you everything I know about becoming an independent, consistently profitable trader. And if you have questions about any of those, feel free to shoot me an email, akil@tradeempowered.com, or just leave a comment below. So what we're going to do today is take a look at the euro dollar, and I'm going to show you an example of what I look at when I break down a price chart. Now, I'm going to stick to the daily chart mainly because tomorrow is Jobs Day. And if you guys are unfamiliar, Jobs Day happens the first Friday of each month. It's when we have our non-farm payroll release along with a few other fundamental releases. And essentially, it's just a day that you don't want to trade the markets. And I know some of you are going to fight me on that. Some of you are going to say, oh, there's so much action, I need to be involved. But if you saw the video I put out earlier this week that talks about the reality of trading and kind of the pressures that are on you once you become a full-time trader and once your income or your livelihood, I should say, is based off your trading performance, you'll see that you don't really want to be involved in gambling type positions like this, especially when so much is at stake. Again, some of you guys are going to fight me. You're going to tell me how you can research the number and look at the forecast and make sure you're on the right side of the position every single time. And that's great if you are. It's just something I don't personally look to be involved with. So what I'm going to do is we're going to do some analysis on the daily time frame. And I'm going to bracket the markets, meaning I'm going to show you what I'm looking for if the market goes bullish, what I'll be looking for if the market goes bearish. That way, it provides you with a good example of our IPDE process: identify, predict, decide, execute, and how we look to stay one step ahead of the markets at all times. All right, so we're on the daily chart of the euro dollar. And as you can see, I scrunched up my chart really small just so you can get an idea of what the market's been doing really over the past year and a half. And you can see that we were in a serious downtrend starting back in about May of 2014. And really, once May 2015 came, we came into an area of consolidation. And for you guys that may be new, consolidation, well, there's two ways that the market moves. It either trends, we see directional movement. So you can see an example right here of moving from our swing highs to swing lows, or we go into consolidation where the market is essentially moving sideways. Now, if you want to learn more about this, head over to our website, www.tradeempowered.com, and I recommend checking out the video titled Into the Gray. It's under the Learn to Trade tab. But to make things simple, you can tell if a market's in an uptrend if it's moving from the bottom left of your screen to the top right of your screen. You can tell it's in a downtrend if it's moving from the top left of your screen to the bottom right of your screen. And you can tell it's in consolidation if we're just going sideways. You can see there's no real trend direction. If I just take my arrow key, look at this. We're going up, retracement, new structure high, outside return, previous structure holds, previous outside return holds. Then we get a higher high, higher close right here, thinking that we may be in a bullish trend. And then we come back down. We refuse to test previous structure highs. And then finally, we break and create new structure lows. We get a retracement from that. Once again, we refuse to test our previous structure lows. We break our outside return to the upside, come back down, put in another outside return in the opposite direction. Eventually make new structure highs. We retrace, refuse to test structure highs again. Now another lower low, lower close. You're probably saying to yourself, Akil, I have no idea what's going on here. When that's the case, right? When we don't have that, what's the word I'm looking for? When we don't have that sequence of new structure high, outside return, new structure high, or new structure low, outside return, new structure low, you can make the good guess that we're in consolidation, and that's exactly what we're doing here. Now, consolidation isn't necessarily a bad thing. For you guys that are advanced pattern formation traders, consolidation often yields a lot of advanced pattern formations. You can see in here, there's at least two recent ones that I remember. We had a bearish bat formation right here, X to A to B, B to C, C to D, right up here. And more recently than that, we had a bullish Gartley formation, looking at X to A to B, B to C, and actually a C to D completion right down here on our Brexit spike. So consolidation is not always a bad thing, but it depends on what type of trader you are. So zooming in and getting more recent, there's a little lesson on structure for you guys. Again, if you want more knowledge or a better lesson on structure, go over to our website, tradeempowered.com, and just check out that Into the Gray training session. It's free. It's 2.5 hours. It's right under the Learn to Trade tab. Also, if you're on our email list, you'll learn about what's coming up soon. So make sure you're on that email list as well. And all right, so let's zoom in on the daily chart and get a closer example of what's going on. I want to walk you through the process that I do, or the routine, the ritual that I do to break down a price chart each and every day in my live trading room, and of course in my own personal top-down analysis as well. And that's the IPDE process: identify, predict, decide, execute. The first thing I want to do is I want to identify what the market's doing, and as we talked about already, the market is in consolidation, right? The market is in consolidation. So the first thing I ask myself is where is the market at? Where is price action at relative to structure? And our two major structure levels are going to be up here. Here's our major level of resistance. If I can find my right tool, here we go. Here's our next major level of resistance up here. Here's our next major level of support down here. So it's kind of a weird zone. It's really here, but we got to pay attention to these lows as well for stop loss purposes. So we'll draw it out like that. And in general, support and resistances, there's zones anyway. But I'm saying to myself this: if price action goes lower, where are we likely to go? That's the prediction part. My prediction is going to be to this area down here, previous structure support. Again, support and resistance act like a magnet. Market or price action wants to be drawn to it, dragged to it. So if price action goes lower, say we get a positive reaction to tomorrow's news event, where are we likely to go? This area down here. If price action goes higher, say we get a negative reaction to tomorrow's news event, where is price action likely to go? Well, back up here to previous structure resistance. Now, the next question is, if price action goes to these levels, how would I be able to get involved as a trader? And I can tell you this. Let's start with the bullish example. Let's say we have a positive reaction to tomorrow's non-farm news and the market spikes up. Well, how can I get involved in a trade up in this area? Well, we actually have an advanced pattern formation lurking up there as well. So if I take my Fibonacci retracement from my swing high to swing low, and this is going to be easier seen on the 4-hour chart, it'll break up this big candle, but we started on the daily, so we might as well stay here. This is going to be my X leg, and this is going to be my A leg, and this is the start to every advanced pattern formation. We need that initial impulse or anchor leg to be our X to A. Now, in this case, because of the Fibonacci ratios that were hit as the market ebbed and flowed in between, we're going to be looking for an advanced bat formation, something that looks like this: X to A to B, B to C, and a CD completion right up here at our 886 Fibonacci retracement, which you can see if we look left, lines up right at that area of structure. And of course, with these advanced pattern formations, our stop loss needs to be above our previous structure highs. So you're definitely getting your stop loss above that resistance level that we identified. So for you guys looking for bearish opportunities, if price action goes up to that level, then here's an opportunity for you to get involved to the short side. Now for the bulls, let's go ahead and erase this, at least erase our advanced pattern formation here. For the bulls, we have what we call a 2618 opportunity. You can see that the market, again, with our Brexit move, we came down and we created a double bottom. We created a low. We retraced off that low. We came down and created a double bottom, meaning we retested this previous level of support and we held. Next, price action gave us a higher high, higher close. So we broke, drag this down. We broke the previous high, the peak mark, I guess you can say, of our double bottom here. Now, for the 2618 technique, what you want to do is you want to take your Fibonacci retracement from the low, right, to the high of that recent retracement. And what you're looking for is a zone between your 618 Fibonacci retracement and the lows of your double bottom. Now, in this case, again, because we have that Brexit spike, you certainly want to have stops below this area. But this would be the 2618 kill zone. If you guys are interested in learning about that, If you're in the syndicate, we have that under the syndicate training course on the syndicate dashboard. If you're not in the syndicate, if you're new, again, just head over to our Trade Empowered website, www.tradeempowered.com. And I believe either on the homepage or the Learn to Trade tab should be the 2618 training, which you can sign up and you can learn more about this technique for free. But this is your 2618 kill zone. And of course, how you attack the trade in this kill zone is up to you. You can be aggressive and put a buy limit order right at the 618, or you can say, Akil, if price action enters my kill zone, then I wait for and insert your specific entry technique in the blank. I can tell you what, in this situation, you probably don't want to be aggressive. Let me just look at the risk reward. And this is under the assumption that you require a 1-to-1 risk reward. Not everyone does, so technically you don't need it, but most traders that we work with, they require a 1-to-1 risk reward. Again, stops need to be below our Brexit lows here. Target's going to be at a retest of previous structure highs. It looks like, if I can get this tool to work, where are you at, tool? I'm not good at trading view tools. Sorry, guys. I'm getting better. I'm getting a lot better, but I'm not good at it. I just messed everything up here. There we go. It looks like we're a little less than 1-to-1. So again, if you need to be an aggressive trader, you can just adjust your stop or adjust your entry, right, down a little bit. That way you have a better than 1-to-1 risk reward. You'll see Charles, who's been running our syndicate war room each and every morning in his war room meetings. He's been doing this a lot. He's had a few opportunities where he had the 2618 and then he adjusted his entries to get that desired risk reward. Or, like I said, you can look for a specific entry type inside this kill zone. Either way, this would be your opportunity to get short. So again, what you see is that we want to be one step ahead of the markets. We don't want to emotionally react to what the market does. We don't want to be caught off guard. We don't want to be in a situation where the market moves and now we're chasing it. Oh, it's going up. I got to get up too. No, we want to put ourselves in a position daily where we're one step ahead of the market and we already have a plan of attack no matter what the market does. So again, tomorrow, as we go into our non-farm release, it doesn't matter whether the market goes up or down. I'm not trading that news, but I know if the market goes up, and I say I as a trader, we all, right? Imagine yourself in this shoe, right? If the market goes up, boom, I know exactly how I'm going to attack it. Waiting for advanced bat formation. I'm getting short at the 886. Boom, done. If the market goes down, well, I have 2618 opportunity. I'm looking for a double bottom with RSI divergence inside that 2618 kill zone. Boom. Right? Now think about how comfortable that is compared to what you've been doing. There's no stress. There's no heart pounding. There's no watching the market move and making an emotional decision before it's too late. No, we're sitting back. We already know exactly what to do, and that's the way we keep the emotions really out of our trading. We just wait for that if-then thought process. We wait for what we see on the chart to match what we see on in our trading plan, and that's how you become, or that helps you. Not how you become, but that helps you maintain that consistency in the market when looking for execution. So yeah, it's a process, guys. It's a process, but if you make a routine out of it, it gets a lot easier. And I challenge you, try it for a week. Try to stay a step ahead of the market for a week and see if it makes a difference in your trading. I think it will, but only you will be able to answer that question. So you often hear me talk about how trading is a process, and usually I'm referring to the technical side of things and how we're breaking down a price chart, as in the example I just showed you. However, trading as a whole is a process as well. And I got a great quote from a trader today that I want to read to you, and it says, Akil, after almost 1.5 years of not trading live money and spending time in the live room, I started trading again 4 weeks ago and went straight into an 8% drawdown in the first 2.5 weeks. However, I didn't have any emotions and I stuck to my plan and I managed to pull myself out of it, plus more, in the last 1.5 weeks. The rush of trading a plan and seeing it play through has me hooked. I just turned 21 and I finally decided what I'll be doing for the rest of my life. And that's an awesome quote. And what's important is that trader has a belief. I'll give you a secret, guys. Drawdowns are going to happen. I don't care how good you are as a trader. I don't care how great your strategy is. Everybody faces a period of drawdown. The difference between those who find consistent success in trading and those who fail out is all about how you handle that drawdown. Do you have a belief in yourself? Do you have a belief in your trading plan? And are you able to trade through that dark period and see the light once again? Or are you going to start making mistakes and either blow your account or just give up? And I'll tell you this: once you make it through your first drawdown, it just gets easier. It's still going to hurt. It's still going to suck. But at least you have the belief and you have the confidence that, hey, I'm able to dig myself out of this hole and achieve profits again. And we showed you an example of that on our equity curve last week, where we talked about how we were in a drawdown for the last, 10 weeks or so. And even last year, we went through a drawdown, I think, for 20 weeks or sideways movement before eventually achieving new equity highs and finishing the year for pretty good return. And it's necessary. That's how trading is, guys. Trading isn't a sprint. It's not about day-to-day returns, week-to-week returns, month-to-month returns. It's really about the big picture. It's more of like a marathon. And trust me, take it from someone who's ran 2 marathons in his life and made multiple mistakes doing so. If you go about it the wrong way, you will get destroyed. If you try to rush out and do stuff that you're not supposed to do, it's going to bite you in the butt later. All you can do is have a plan going into the year or the race. Have a plan, stick to that plan, and trust that all of the work you did beforehand, all of the training that you did beforehand to build that plan or build that endurance to run the marathon will show itself, and it will pay off when you start actually trading or running live. I probably butchered that analogy, but I hope you guys get the point. Trading is a big picture event. It's not about the day-to-day actions. It's not about the month-to-month actions. It's what you do in the long run. And before I let you go, here's something that I like to use. I showed you guys this last year and you got a kick out of it. I can see the comments coming. Here's what's commonly thought of in the professional trading world, right? If you can average 2% a month, right? And that's, again, not counting money management, because money management can bump that up another 20% at the end of the year if you know what you're doing. But if you can average 2% a month, of course, with a limited drawdown, you're considered a good trader, right? If you can average 5% a month, right? Again, with a very minimum drawdown, minimum risk, you're considered a very, very good trader. So what I like to do on my equity curve, especially when things are going rough, is I like to show a graph that has both the target marks for a 5% return average and a 2% return average, and see where that equity curve lands. And as you can see, even when we're faced with a drawdown, as long as we're in that area, that just gives me a little extra confidence that says, hey, Akil, this won't last. We're still on track for the bigger picture goal. We're still on track to hit that final time in the marathon and what we wanted to do. So it may not work for all of you. It works for me. I had another trader on Twitter last week say it works for him as well. When he gets in a drawdown, he likes to take his back testing equity curve and look at that. And that just gives him confidence that things will be all right. Whatever trick you can use, even surrounding yourself with great individuals helps as well. Misery loves company is what they often say. But it is natural. It is a part of trading. Focus on the big picture, guys, and that's where you'll really see the benefits of your hard work. So hope you guys enjoyed this video. I will see you next week. Until then, plan your trade, trade your plan. Take care. This, however, is a free video. This is something I put out for YouTube each and every Thursday, where my goal... Hey traders, my name is Akil Stokes, and thank you for joining me for another weekend review video. If this is your first time, Hey traders, Akil Stokes here, and thank you for joining me for a weekend. Hey traders, Akil Stokes here, and thank you for joining me for another weekend review video. If this is your first time, Hey traders, my name is Akil Stokes, and thank you for joining me. Hey traders, my name is Akil Stokes, and welcome to another weekend review video. If this is your first time joining me, you're gonna face a drawdown. Your system is gonna, I'm gonna bracket the market. I'm gonna give you guys trading. Hey traders, Akil Stokes here, and thank you for joining me for another one. Hey traders, Akil Stokes here. Come on, man. Hey traders, Akil Stokes here, and Now, we often talk about the process of trading when it comes to technical analysis. Again, IPD is a great example. It's a great habit and a routine that you should